Welcome to This Week on Wall Street, your essential briefing to what matters most in markets. I'm Matt Weinschenk, the Director of Research here at Stansberry Research. And look, some investors love gold. I've always found it dull. When you start talking about drill sites and mining assays, it makes my eyes roll back in my head. But something wild is happening with the yellow metal over the last couple of years, and I think you need to pay attention. So last week, gold's price cracked an all-time high above $3,000 per ounce, but this has been an unloved and largely overlooked rally. But this week, we're seeing evidence that investors are finally starting to take notice, and that could mean more room for gold's price to run even higher. So let's break down what gold's been doing and what it could mean for your portfolio. So first, for most investors, gold is a way to protect your wealth. It's a store of value, and it's been a store of value over an extremely long time. The Roman Emperor Augustus paid his Roman centurions a salary of 38.58 ounces of gold. Now, at the current price of gold, that's about what a major in the army earns today. Also, for hundreds of years, an ounce of gold has represented the price of a fine men's suit. It's been the same throughout history. So you could sit and come up with examples like this all day long. The point is that gold is there to protect your purchasing power, preserve your wealth, and it can also work to smooth out returns in your portfolio. The wisest investors think you should have something like 5 to 10% of your portfolio in precious metals. And I'm talking about guys like Ray Dalio, Harry Brown, Paul Tudor Jones, Jeff Gundlach, and other big thinkers about risk and asset allocation. But there are also times when gold prices are rising quickly, and that can present an opportunity for investment. And it also tells us something important about the economy. So that's what's happening now. Gold prices have surged from $1,600 per ounce in 2022 to over $3,000 today. And the question is why? After all, there is a playbook for gold. It's been used as money for more than 5,000 years, so we understand how gold moves and what drives it. Two ideas tend to drive gold in most markets. One idea is based on fundamentals and interest rates, and the other is based on sentiment and fear. But what's interesting is neither of those have driven this gold rally. So let me explain. First, gold tends to rise when interest rates are low and inflation is high. If investors can't earn much in bonds and they worry about inflation eating away their purchasing power, they go and buy gold. But neither of those things are true right now. 10-year treasuries yield about 4.3%, and inflation is tame at around 3%. So what you would say as the real interest rate is not negative. That's when gold tends to rise, but not happening right now. On the sentiment side, folks buy gold when they are scared and fearful. Gold rose during the global financial crisis, and it spiked again during the pandemic in 2020. And it's true, we've seen a few weeks of fear related to this market correction, but over these past few years, gold has been rising alongside a very strong and confident bull market. So what gives? The truth is, today's desire for gold comes not from the panic of flighty stock investors, but from deep-seated fears of geopolitical turmoil that have central banks worried about the state of the world, okay? Central banks have been stacking up net purchases of gold to the tune of 1,000 tons per year, and that's well above average. They want to build up stockpiles of a hard asset to protect their domestic economies. Now, this buying started shortly after Russia's invasion of Ukraine in 2022. In many ways, Russia's invasion completely upended the global order. If you look back, since the end of World War II, we lived in a world where countries didn't really invade sovereign nations in wars of conquest. The international community simply wouldn't allow it. But if Russia's attack portends a more warlike world with less international cooperation, that makes countries want to hold a larger stockpile of gold. At the same time, after that invasion, the United States froze the assets of Russia's central bank. So other companies saw this financial power of the United States, and they decided, we better hold some more gold in our vaults. So that all started taking effect in 2022, but the buying has continued since then. Trump's non-traditional approach to international relations and his threat of tariffs have led central banks to want to buy and import gold now. So that's the story of the last few years. but there's something new happening just in the last few weeks that could mean more room for gold to run. So that's why I wanted to bring in Brett Eversole. He's been with us at Stansberry Research for over a decade. He's the editor of True Wealth, and he's the best trend watcher I know. That means he scans global markets from a top-down level, and he understands what assets are on the rise and why. I do want to point out that Brett's been covering gold for years. Specifically in his newsletter, he recommended readers buy into a leveraged form of gold in late 2023. Gold was around $2,000 an ounce then, and he said it would blow past $3,000. Here we are. That investment has doubled. So Brett's the kind of guy you want to listen to on this stuff. Brett, let me start with this. Do you consider yourself a gold bug?
Well, first, I would say thanks for having me, Matt. I'm excited to be here, excited to share what I see in the gold market. And I'll say I definitely do not consider myself a gold bug, though I will say there was a time early in my career where I might have gone down that path. So I say that because I started in this business in 2010 at Stansberry Research. And if you remember 2010, we were coming out of the financial crisis. Honestly, the hottest thing in the investment world at this time, it's kind of crazy to think about right now, was gold, gold stocks, junior mining stocks. This is where people were making tons and tons of money as we came out of that '09 period through when gold ended up peaking in either late 2011 or early 2012. I can't remember exactly. And during that time, I was just inundated with all of these ideas that gold is this forever asset. And we were, a decade into a bull market where the metal had gone up 4 or 5 times. And it just seemed like this completely obvious trade. So early in my career, I kind of had some gold buggy type tendencies. But then I saw what happened over the next 4 or 5 years where gold fell by around 50%. And I realized that, like most assets, this is a highly trending type asset. Gold can go up an incredible amount in a short period of time at the right time, but then it can go through these just absolutely brutal multi-year bear markets. So to me, I definitely don't see myself as a gold bug. I think it is the kind of thing that you can make a lot of money trading at certain times. And I think we're in one of those times right now.
Yeah, Brett, I don't consider myself a gold bug either. I even brought all of my gold today, if you'd like to see it. This is my 1/10 of an ounce of gold, if you guys can get a shot of that. I think I got it for $80. It's worth $300 now. So I do have that going for me. But I mean, I much prefer to buy businesses rather than metals. But there are those people who just have this emotional attachment to gold. They always think gold's going to go up. And over the long sweep of history, it does tend to go up. And of course, they're paying attention to this gold rally and they are loving it. But for the most part, this gold rally, investors have completely ignored, even though it's hitting new highs. Isn't that true?
Yeah, that's definitely what I have seen. And, I've been writing about gold pretty excessively for the past 12 to 18 months. And what really surprised me, we had our Alliance conference last fall in October. And at the time, gold had been soaring all throughout 2024. It was around, I think, breaking around $2,700 an ounce then. And there are 3 coin dealers at that conference that I've known for, over a decade. And speaking to all 3 of them, I expected going into those conversations that they would be saying that their phones were ringing off the hook, that retail investors were excited, they wanted to buy, that it was just like a booming type market for sales. What they told me is that the phone doesn't ring. Nobody is interested. No one seems to care. There's just no retail enthusiasm for gold. And so to me, that was incredibly exciting because I know how these booms always take place, right? You start with smart institutional buyers, prices go up, and then eventually retail comes in. So learning that last fall told me that no matter how much gold had gone up, there was a lot more to this boom on the way. And we've seen that happen over the 6 months since that conference. And I think that there's still a long way to go in this boom.
Yeah, this is what we do at Stansberry Research. We try to dig into these things and find the drivers and realize what's actually happening in the market. So you look at things like the gold to silver ratio, right? Central banks are buying gold. They do not buy silver. And you'll see that silver has not participated in this rally. Usually they move kind of together. And also gold mining stocks, right? Central banks are buying gold. They're not buying gold mining stocks. Those are usually a sort of a levered bet on gold, and they have lagged behind as well. But you also see, you can see this in ETFs. Have you been looking at that data?
Yeah, so this is the interesting thing that's happened, I would say, this year. So I love to look at ETF shares outstanding. This is something that a lot of people don't even realize how powerful of a tool it can be. So an ETF has the ability to create shares when people come in and buy more of that fund. So if I have $10 million and I want to go buy the Spider Gold ETF, ticker GLD. I go into my brokerage account, I buy that. Those shares don't exist. So the ETF provider creates shares, sells them to me, and then goes and buys the assets to fill up that share count. Now, if I go and I sell that $10 million worth of shares the next day, they're going to liquidate those shares and get rid of the underlying assets. So the share counts of these ETFs are always moving up and down. Now, if you look at a very large, like SPY, a very large S&P 500 ETF, the share count just goes from the lower left to the upper right. It just gathers assets. But when you're looking at smaller funds, and more importantly, hyper-specific funds that invest in a very specific thing like gold, the ebb and flow in these, the overall share count of these funds can give you a really powerful insight to what retail investors think about an idea at any given time. So for the two major gold funds, GLD I talked about, and then the iShares fund is ticker IAU. These both had their share counts peak in 2020, and they both declined by about a third since then to their lows last year. Now, what's happened in the past 3 to 4 months is that those share counts for the first time since 2020 have begun to reverse. They've risen by 15 to 20%. But here's what's interesting. So that tells me two things. It tells me that retail investors, those are the kind of folks that buy these kind of funds, are finally moving back into gold. I think they've seen that break above $3,000 an ounce. They've seen U.S. stocks have a tough go in the last few weeks, and they realize, oh, this is a boom that I should be participating in. So they're starting to buy in. These funds, though, there's still, I think, a lot of buying left. So they're both still about a third below those 2020 highs. And I think in every boom, you can expect to hit newer and newer highs. Now, these are pretty large funds. Between the two of them, they've got about $130 billion in assets. So if those assets were to grow by 50% on new buying, that'd be $70 billion of new buying into the market from these kind of retail investors. I think that could prove to be conservative depending what the price of gold does. So I think there's a lot of buying from retail. It's just begun, and there's a lot left to go. I think that is what's going to drive kind of the second phase of this gold boom.
Yeah, so I wanted to point out to our readers, this tracking of shares outstanding is a really cool tool you can use. Brett's talking about using it on gold. You can use it on things like levered ETFs on the QQQs, and it gives you a really good insight into what investor sentiment is, right? That's sort of these crazy speculators, and when they start to come out, you go, oh, maybe people aren't as aggressive on the market. So you can use these on all kinds of funds across the board. But Brett, you're saying that retail investors are usually last to get into these things. And even though central banks have been buying all this stuff up, there's still enough room for when mom and pop start saying, hey, honey, we have to get some gold. You think they can still drive this market higher?
Yeah. So, I mean, if you look at history of booms, this is how they always play out. There's always, at the very early stages, before prices have really started moving, there are very early adopters. In the gold space, this might be the gold bugs that were just always going to be there anyways. They're always going to be accumulating. And then what you might call the smart money, the big institutions. There's going to be institutional buyers that are going to come in and start to drive the early stages of the next phase of that boom. In this case, I think that is definitely the central banks globally. And those people tend to keep buying throughout the boom. Eventually, what's happening, prices have risen enough that regular folks start to catch wind of it. That's the retail buying. And I would say that institutions are generally, people call them the smart money. I would say not necessarily because they always know what's going to happen next, but because they are not as primed to make really stupid speculative decisions. Retail doesn't have that problem. Retail is happy to just keep buying as prices rise. And because of that, it's always the retail phase, that final phase of a boom, that leads to the biggest gains and I would say the least good possible outcomes. But that's how you turn from a boom into a bubble, is potentially through that retail buying that's going to happen. And that can take a long time. Like when I started in 2010 and gold was booming, I was definitely into the retail phase of that boom. It was through the mid 2000s when gold went from, $250 or $300 an ounce to $1,000. That was when institutions were buying. And then you come out of the global financial crisis and prices started soaring, and then retail was driving that. But if you think back to what I remember back then is you would drive down the street and there would be "We buy gold" signs, guys out front, spinning the signs and trying to get people to come in and sell. If you turn on any kind of television, financial or otherwise, there was "We buy gold" commercials. It had become very much the way crypto has at times over the last few years, just a very retail, obvious, everybody knew about it type boom. So I think we're in the early stages of retail buying, but we are very far from that potential outcome. And when you start to see those things, that's when you can worry. That's when you can say, okay, maybe we're getting to the end of this, and maybe the prices that we're seeing are being driven by rampant speculation. And when that goes away, prices are going to come down a lot. But to me, I think we're maybe like, fifth, sixth, maybe seventh inning. But retail is going to drive it, and we're just not anywhere near that kind of crazy sentiment that you would expect to see at a top. So to me, I see $3,000 gold, and I think, I don't know how far we can go, but it's just, there's not that much hint of speculation now. So maybe 4,000, maybe 5,000. It's hard to know. It's not really about the price. It's about how the general investor base is thinking about the metal. Once they start to think about it as this no-lose proposition that everyone knows about, that's when you start to get worried. But we're very far from that right now.
Yeah, and you say 5th, 6th, or 7th inning, but those last innings are the big one. Those are the ones where the melt up really happens, so to speak. All right, well let me step back from sort of a prediction of the current gold market and just ask you, because I know you've done work on this. Isn't it true that gold and precious metals are an important diversifier for retirement accounts? And it's something that financial advisors often overlook. Even if you don't think gold's going up, there's a reason to hold a portion of it in your retirement account.
Yeah, I definitely think that's true. I started by saying that I'm not a gold bug and I don't view it as a forever asset. I think of that more as an investor on an individual basis, not as a portfolio construction. When you think about constructing a portfolio, your real goal there is to have the highest return possible with the amount of risk that you're willing to take, the amount of volatility. Gold, like bonds, has a tendency to zig when the overall stock market zags. And so it has a lot of value as a diversifier in a portfolio. So people talk about like the 60-40 portfolio, 60% stocks and 40% bonds. There are a lot of times in history where stocks and bonds correlate together, but gold does not correlate in those moments. So I think if you put together a 60-30-10 portfolio with the 10 being gold, I don't have those numbers offhand, but if you run that throughout history, I'm almost certain it's not going to degrade your returns whatsoever, and it's probably going to lower your volatility. So to me, taking part of your bond allocation and putting it into gold is a smart way to get just the same kind of benefit that bonds are going to give you, but they're going to give it a slightly different way, which is really what you're after when you're constructing a portfolio, which is different than thinking about it as an individual investor on an individual asset at an individual time. Yeah,
if you were holding gold post-financial crisis during the pandemic, it just makes you feel a lot better not seeing your account draw down by as much. I've played with these things too. You can cut your drawdown from 30 to 20%, which doesn't sound like it's that important, but when you're sitting there looking at your account, it's very appealing, especially if you're getting closer to retirement or getting ready to live off these savings. Well, Brett, thanks for joining us. I want to point out that at Stansberry Research, we produce tons of free, high-quality research about gold and so many other investment opportunities. You can sign up for that, again, completely free at stansberrydigest.com. And, of course, like and subscribe on YouTube to stay up to date. That's all we have for this week. We'll talk to you next week.